The journey of OCR rate hikes. As New Zealand navigated the economic landscape post-2023, the Reserve Bank continued its cautious approach to monetary policy. By mid-2023, mounting inflationary pressures and robust economic indicators prompted the RBNZ to embark on a series of OCR increases, aiming to anchor inflation expectations and maintain price stability. The decision-making process behind each OCR adjustment involved a meticulous analysis of economic data and global developments. Key indicators such as GDP growth, employment figures, inflation trends, and consumer spending patterns were scrutinized to gauge the economy's resilience and potential risks. Additionally, external factors including global supply chain disruptions, geopolitical tensions, and fluctuations in commodity prices were considered in shaping the RBNZ's policy stance. The first steps towards higher OCR rates began with incremental increases throughout early 2023. In January, the OCR was raised to 2.5%, followed by further adjustments in March and May, each time increasing by 0.5%. These moves reflected the RBNZ's proactive stance in addressing inflation, which had consistently exceeded the target range of 1 to 3%. By mid-2023, as the OCR reached 4.0%, discussions intensified around the potential impacts on borrowing costs, consumer spending, and investment. The RBNZ maintained open communication with stakeholders, emphasizing the importance of achieving price stability while supporting sustainable economic growth. Market reactions varied, with some sectors welcoming the gradual normalization of interest rates as a sign of economic resilience, while others expressed concerns about the affordability of credit and its potential dampening effect on consumer confidence. Throughout the latter half of 2023, the RBNZ continued its measured approach, raising the OCR by increments of 0.5% in September and November, bringing it to 5.0%. These decisions were underpinned by the central bank's commitment to containing inflationary pressures and ensuring long-term economic stability. By December 2023, the OCR stood at 5.5%, marking the highest level in recent history and signalling the culmination of the RBNZ's tightening cycle. Comparatively, the OCR rate of 5.5% placed New Zealand among the countries with relatively high interest rates globally. New Zealand's decision to raise the OCR to 5.5% underscored its commitment to price stability and proactive management of inflation expectations, albeit at the potential cost of high borrowing costs for businesses and consumers. The implications of a high OCR rate in New Zealand extended beyond domestic economic considerations. The exchange rate, influenced by interest rate differentials and global capital flows, played a crucial role in shaping trade competitiveness and external balances. A stronger New Zealand dollar resulting from higher interest rates could potentially impact export competitiveness, particularly in sectors sensitive to currency fluctuations. Looking ahead, the RBNZ's stance on monetary policy remained data-driven and adaptable to evolving economic conditions. The effectiveness of OCR adjustments in achieving desired inflation outcomes while supporting sustainable economic growth would continue to be closely monitored and communicated to stakeholders. The central bank's forward guidance and transparency in decision-making aim to mitigate uncertainties and provide clarity to financial markets and the broader public. In conclusion, New Zealand's journey towards an OCR rate of 5.5% represented a significant milestone in its monetary policy framework post-2023. The gradual tightening cycle reflected the RBNZ's proactive approach to addressing inflationary pressures and ensuring price stability amidst a recovering global economy. RBNZ policy reflects New Zealand's recent monetary policy, characterized by an aggressive cycle of OCR hikes initiated in October 2021. Initially termed an experiment, this approach aimed to combat rising inflation but ventured into uncharted territory due to its unprecedented magnitude and pace. While recent inflation figures suggest some success in curbing price increases, concerns persist regarding the broader economic impact. Despite the temporary relief on inflation, the economy has faced significant challenges. GDP growth has been sluggish, with multiple quarters of contraction and bleak prospects for the upcoming June quarter. The possibility of prolonged economic downturns reminiscent of past crises, exacerbated by per capita GDP declines exceeding post-GFC levels, underscores the severity of the situation. Critics question whether the OCR hikes may have been excessive, given the substantial 525 basis point increase over a short period.